Let's talk about money and banking. So, in this chapter, we'll define money by its function, measuring currency. So, I'll introduce you to what currency is, what M1 and M2 is. We'll talk about the role of banks and how banks create money. So, what the world would be like without money. So, back during the early formation of the country, barter was the key. So, trading one good or service for another without using money. For example, we both own farms. You own cattle. I own chickens. I'll trade my eggs for your milk or for cattle. That's barter. The double coincidence of wants is a situation in which two people each want some good or service that the other person can provide. So, exchange, you always want that or need that double coincidence of wants. So, what is money? So, money is four things it's a medium of exchange, whatever is widely accepted as a method of payment. It's a store of value. $100 equals $100. Something that serves as a way of preserving economic value that one can spend or consume in the future. Money is a unit of account. It's the common way in which we measure market values in an economy and a standard of deferred payment. Money must also be acceptable to make purchases today that will be paid in the future. So, commodity versus fiat money. Commodity money is an item that is used as money, but which also has value from its use as other than money. Commodity backed currencies. Dollar bills or other currencies with values backed up by gold or another commodity. Interestingly enough, is the dollar was backed by gold until the 1970s when President Nixon took us off the gold standard. So as of today, as of right now, the dollar is backed by the full faith and credit of the US. There's no commodity backing the dollar today. During much of its history, gold and silver backed the money supply in the United States, but not so today. Now, about government decree, if you owe a debt, then legally speaking, you can pay that debt with the US currency, even though it is not backed by a commodity. What is fiat money? It has no intrinsic value, but is declared by a government to be the country's legal tender. That is our US currency or US dollar is what we consider fiat money. Cryptocurrency is not fiat money. The only backing of our money is universal faith and trust that the currency has value and nothing more. Again, since 1958 until 1958, silver certificates were commodity backed money backed by silver as indicated by the words silver certificate printed on the bill pictured at the bottom. So you see that silver certificate. The Federal Reserve is the central bank of the United States. Bank regulators are responsible for monetary policy and it defines money according to liquidity. The Federal Reserve Bank has two definitions, of money. M1 money supply. It's a narrow definition of money supply that includes currency and checking in banks, and to a lesser degree, traveler's checks. Back in the 70s, traveler's checks were widely used when US citizens traveled abroad to other countries. Today, because of the branding and American Express, Discover, MasterCard, Visa, those are accepted worldwide. The need for traveler's checks has diminished tremendously. So that's what M1 money supply is. What is M2 money supply? It includes everything in M1, but also savings deposits, money market funds, and timed or certificates of deposit. So let's take a deeper dive into M1 money supply. It includes coins and currency in circulation, the coins and bills that circulate in an economy that are not held by the U.S. Treasury at the Federal Reserve Bank or in bank vaults, checkable demand deposits, that's your debit card today, checkable deposits in banks that is available by making a cash withdrawal or writing a check, and then traveler's checks. M2 includes M1 savings deposits, bank accounts where you cannot withdraw money by writing a check, but can withdraw the money at a bank or can transfer it easily to a checking account. Money market fund is deposits of many investors are pooled together and invested in a safe way, like short-term government bonds. And then we have CDs or time deposits, which are accounts that the depositor has committed to leaving in the bank for a certain period of time in exchange for a higher interest rate. This is just a graphical representation of M1, M2 as I just defined. You'll notice that M1 is a component of M2. Again, other than money, plastic money, we have debit cards, credit cards, you know what those are, smart cards like your Amazon or your Starbucks cards that you can buy in your local grocery store. There's the definition there. Most money is in the form of bank accounts, which exist only as electronic record computers. We have payment systems, helps the economy exchange goods and services for money or other financial assets. You use that when you present your debit card to pay for goods and services. That's a form of payment in our payment system. There's a transaction cost for that, which is the cost associated with finding a lender or borrower for this money. Banks bring savers and borrowers together. Banks lower transaction costs and act like financial intermediaries. So, what is a financial intermediary? An institution that operates between a saver with financial assets to invest and an entity who will borrow those assets and pay a return. A good example is at your bank. You have money in your savings account that you want to earn a return on. The bank takes those funds, loans it out to me for either a house or a car, and then I pay interest, and some of that interest goes back to you and your savings. Depository institution is an institution that accepts money deposits and then uses them to make loans. I bank at Bank of America. That's about depository institution. Uh, Randolph Brooks, Chase Bank. Those are good examples. Again, this is just a graphical representation of the bank in the middle. You've got savers who save money, borrowers who borrow that saved money, pay an interest rate on it, and the bank pays you a smaller interest rate. So the difference between what the borrower pays in terms of interest rate minus what the bank pays you is how the bank makes money. Just some terms, you've probably seen these in accounting. Balance sheet that has assets and liabilities. What is an asset? It's an item of value that a firm or individual owns. What is liability? An amount or debt that a firm or individual owes. Net worth is the excess of an asset value over and above the amount the liability, total assets minus liability. I don't think I said that right, so let me try that again. Everybody, net worth is the excess of the asset value over and above the amount of the liability. So if you take total assets minus total liabilities, that's your net worth. Boy, that's much better. Bank capital is a bank's net worth. This is just a simple balance sheet showing loans, U.S. government securities held by the bank, and reserves. equals deposits and net worth. So based on a T account. Reserves are funds that a bank keeps on hand and that it does not loan out or invest in bonds. The Federal Reserve requires that banks keep a certain percentage of depositors' money on reserve. So remember that. We'll talk about that more when we talk about monetary policy. How banks go bankrupt. High rates of default can do it. Asset liability mismatch. So if the bank has more liabilities than it does assets, that could cause them to go bankrupt. What also can cause it is if they make bad loans and they don't diversify their loan portfolio into different sectors, that can cause problems for the bank. We have had a bank go under in recent time. It's out in Silicon Valley Bank. You're welcome to Google that and you can see the bank went under and then it will tell you why it went under. So how banks create money is a simple format is the bank system can create money through the process of making loans. So in this particular example, the Federal Reserve has a reserve requirement of 10%. So what does that mean? So in this instance, the bank has $10 million of loans. It has to keep 10% on reserve and it can loan out the remaining, which is 9 million. So Singleton Bank issues Hank's Auto Supply a cashier's check for 9 million. Hank deposits the loan in his regular checking account with First Bank. The deposits at First Bank rise by 9 billion. It reserves also rise by 9 million. Bank lending has expanded the money supply by 9 million. If Jack's Chevy dealership deposits the loan in the checking account at uh, Second National, the money supply just increased again by 8.1 million, making loans that are then deposited into a demand deposit account increases M1 money supply. This money creation is possible because there are multiple banks in the financial system. They are required to hold only a fraction of their deposits. Loans end up deposited in other banks, which increases deposits and also increases the money supply. I just want to introduce you to the definition that we also have a term we call the money multiplier formula, which equals 1 over the reserve requirement. So in a multi-bank system, institutions determine the amount of money that the system can create by using the money multiplier. The quantity of money in an economy is closely linked to the quantity of lending and credit in the economy. All the money in the economy except for original reserves is a result of bank loans that institutions repeatedly redeposit and loan. A bank can also choose to hold extra reserve above the reserve requirement. Banks may decide to vary how much they hold in reserves for two reasons: the economy or government rules. In a recession, banks are likely to hold a higher proportion of reserves due to the fear that customers are not likely to repay loans, or the Federal Reserve may raise or lower the required reserves held by banks as a policy move. They can do that if the economy is slow. They want an expansionary policy. They can lower the reserve, meaning banks can loan out more, or they can increase the reserve in times the economy is hot or over expanding and they want to slow it down. By increasing the reserve, you decrease the amount of loanable funds, you decrease the amount of money in the economy, potentially that decreases economic activity. Rarely are we going to see monetary contractionary policy. In majority of our history, monetary policy has been expansionary in nature, meaning the economy was slow or sluggish, and we lowered the reserve requirement and made other tools necessary to put more money into the economy. The theory is if I put more money into the economy, then I'm going to increase economic activity. And thank you. That concludes the chapter on money.